What's up everybody, Tom here with another video. Well, they say all good things should come to an end, and of course, we have now broken the streak of the S&P 500 being bullish. 227 trading days later, we snapped our first bearish month. This comes in September. No surprises, the weakest month of the year statistically on the S&P 500 over almost 100 years. So what's next for the markets? We'll be taking a look at that in today's video, and we're talking about whether this is some kind of crash or just a correction with some tasty dips. Stay tuned, guys. Okay, well, let's begin our market analysis for the markets close 30th of September 2021. And we're taking a look here at the S&P 500 heat map, and you'll notice almost everything was red. Some companies like Netflix with very strong technicals on them held up. That had a great technical on it. But in general, it was a red market. And when we go and have a look at the actual movements here, you'll notice there was a bit of sneaky business going on from Wall Street. As is traditional, we've been opening bullish in the morning where the retail hour of power is. Remember, the first hour is mostly traded by retail traders. And then we see that fall off, scaring all retail, taking out stops, consolidation, buying. Many people would have bought the dip here thinking it was going back up. And then the all-important close. This is where Wall Street plays the funny games, and they closed into the low with the Dow Jones being down as much as 1.59%. If we take a look at the sectors, every sector was pretty much down except for IBB. Industrials down the most. Even some defensive sectors like XLP, consumer staples were down. And this time it wasn't tech leading it. Tech has been the weakest for a little bit, but it was not the weakest on this sector. In today's video, we will be covering our technical analysis of the S&P 500, Nasdaq, Apple, Tesla, Bitcoin, and more. But I want to start with PCC. That's the put-call ratio. So it's rising again, which means more puts are being put in the market. And it makes sense, of course, if you have a bit of fear, people will start to load up on the puts. I just want to show two key zones, though, that I often look at with PCC to find bottoms in markets. If you're in a really big correction kind of movement, then generally speaking, if you ever see a really high reading on puts like a 1.83, this is a contrarian indicator. If there's huge amounts of fear, remember what Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. So if there's a huge amount of fear and you're seeing a technical support being found, this PCC being that high can be a signal that we should be near the low. Another one that happens during more corrective periods is around that 1.4. So we'll be watching this almost every day to see whether we ever do get a put ratio at around the 1.4. We hit a key support in the S&P 500 or something like one of those indices, and you'll find that could be, or it's very likely to be statistically the low that we put in. Let's now take a look at the S&P 500 before we go into the options flow and understand where the Wall Street may want to close it on Friday's session. But take a look at this. Not only do we close below, of course, our big channel, our ascending channel here, we then retested it. We're getting a 2050 cross, which is the first time that we've seen a 2050 cross on the moving averages since the pandemic began, all the way back here. We got a cross in May. This is a cross down that we have not seen in quite a while. And we also have our patented kind of lightning bolt here. We've got the peak, we've got the trough, we've got the lower peak. There it is. And we close under here. Where's the next level? 420. Where's the level after that? About 405. 400. And you might say, well, why is it those levels that you're looking at? And it all comes down to certain moving averages. We know that the 405, see the previous support here, guys. We know that this level and the 50 exponential moving average are very common in corrections. We also know that most corrections, technical corrections that is, go between 8 and 10% down. So that is exactly 10%. See how it's such a perfect level? And if we scroll out and we think about most pullbacks on the S&P 500 over time, take a look at this 50 exponential. There are deeper ones, but being correct on picking those deeper ones is unlikely. We've been in a very strong trend and we have not touched the 50. Remember, here's a 50 touch over here in a strong trend coming up. We have not touched the 50 in ever. Like, you know, it hasn't happened really since that big fall movement through in June when the market started to rip. So this could be the correction we're looking for. This level makes a lot of sense. What do you guys think in the comments down below? Do you think this market's going bearish? Let me know, bullish or bearish for the next week, because next week's going to be super exciting. We've got non-farm payrolls coming out, And if we close under here on the Friday session, 420 and even at 405 become open, I'm really looking at that 50 exponential moving average as a key level. SPX, it's the same thing. You go across, you'll notice here that 42 kind of 30 zone, somewhere around there being a key resistance becomes support. And then we've got that 4,050, which is of course the 405. We go over to the weekly. There's the 50 exponential moving average, exactly where we would love to see that market become. Now, many of you won't want it, but it could become the reality only in a few weeks. You got to be fast, you got to be nimble, and as we've been saying now for 2 months, August and September tend to be weak, tend to be at least neutralized. So we were going with the idea of being fast and nimble since then. And you know what? Big brain people in the community, you've been correct. We've been correct here. The market has been falling. It has, of course, been very, very quick both ways. And of course, there are all these concerns coming out about Evergrande, about US debt ceiling. You could name it. There's 20,000 reasons to be a bear, but we do still know the markets are an optimistic beast. So we've got to be careful. Let's have a look at the options interest by strike. So here's the expiry for the 1st of October, this Friday in the close. And we have here a 420 put wall. We obviously have some puts and calls that are kind of equalized around this area. We're taking a look at that in a second. And we had that huge call wall at 450. So really, Wall Street would like to close it within this range. Whether they close it on the low here or the up here, they haven't caused necessarily maximum pain. But these are these outlier zones are what I use with my technical analysis to try to find key supports or resistances that can be more helpful. When it comes to October, the 3rd week of expiries, it's still just very, very, very reasonable to say that 450 should not be closed above. There's just way too many calls open there, and we knew that. We've been talking about it for weeks. We also have a little bit of information that's been shared here from a member of the community, Ian. So big shout out to Ian. He's been doing some good work here. We've been having some discussions, and what he's created is effectively the same chart here between the puts and the calls, and he's worked out the maximum pain level. So effectively that means that if the market was able to close just underneath 440, Wall Street would make absolute optimum profit. Now, this will not always happen. I tend to always go with the bigger outlying points because otherwise you can get confused. But yes, if they were able to, they would close it right here for maximum pain. So that is, they would make the most amount of money and it would be very fantastic. Generally speaking, I will use the big outlier points, but it's great information anyway. So thank you very much for that. In October, so this is the one that comes in the 3rd week, we have a little bit different. We're seeing on the SPY around that 440 kind of area would be the maximum. Bit early to tell here because all we know is we have huge amounts of 450 calls, which are most likely retail, and these puts will start to rise as we get close to the event. So we'll continue updating you on these on the channel as we go. So remember to subscribe, guys, and of course smash that like button if you do enjoy these videos. It helps us out a lot. Tesla, let's take a look at Tesla. So we hit close to the 800. We've talked about the options at 800 this week. We've also talked about the massive amount of options that were randomly sitting around 700 and 720. We still expect them to expire worthless. We have a 760 previous resistance that could act as a very good support. We're looking probably now to Tesla coming down to this level. And realistically, this has been a pretty good stock to be holding during this pullback. You've got to think about it from the perspective of what Tesla's done. Tesla has gone up during the pullback and it has solidified a position right around here. Most stocks have been falling. The Nasdaq is currently, as speaking of this video, at 14,622 on the futures. It's down another 0.6% from the close. And really, Tesla's just been doing amazing. So we've still got this great trend line here. We've still got the long leg doji. We're still stuck within the range of the long leg doji here on the daily. We close above 800. Boom goes the dynamite. This is where we go to that 880 kind of target and people will start to press in on that. If we pull down to 760, I expect buyers to be there. And if we do get under 760, look, that is unfortunate. I do feel like that at that point we're talking about going back to our trend line. But at the same time, if we get underneath here, it's highly likely the market is semi-collapsing into the next support. So we'll talk about that when and if it does happen. Open interest by strikes. Still lots of puts on Tesla for some reason. Who knows who that is? 800 was the biggest call option strike this week, and anywhere in here is really fantastic for Wall Street. They're very happy with it. Not much to really ascertain from here. Sometimes they're more useful than not, but we still want to cover them. And really what I guess we're looking at more is the technical of that 760 holding up. Let's hope it does. Let's move over to Apple now. So this is the linchpin in the markets. If Apple closes below this point, again, what happens? We get the peak, the trough, the lower peak, the lower trough. We close below, and then we're starting to talk about 130, 135. My favorite level for Apple actually is this, because we have a beautiful trend line that's held up. I'm sure many investment fund managers are looking at this line and they're licking their chops getting ready for it, because for their clients, they might be saying, oh, I quite like this level, guys. And then they can go and show them some report and it might say, we believe Apple's worth 160 over the next 12 months. It's a very compelling story. It's easy to buy Apple for these guys because they know people are familiar with it, and what a fantastic trend line it would be. So yeah, underneath here could open the floodgates. All of a sudden we move down to these levels and everyone is probably a little bit upset, but at the same time, if we see lightning bolts off here, so we see it come down, move up like that, fantastic. We've had it before over here. Look at this, perfect, great rebound, perfect move, fantastic trading. And that's the type of thing you do want to find in the markets. Does it make sense? It certainly does. Way too many calls open this week on Apple. I don't know what people were thinking, especially these guys over here. They've got sad face right now. I very much don't think they will be making any money. It would take a bit of a miracle. But yeah, huge amounts of options calls opened, meaning that it is in Wall Street's best interest to close it underneath. And I would say a lot of those Apple stocks, which are traded heavily by retail, would be retail losing money. Let's take a look at the US 10-year. A few days ago, everyone was worried about this. It hit the 1.55. It's now found some resistance, which we do expect. I don't feel that the US 10-year will not try to go through this level. I think most people that have been following the markets for a long enough period might think it pulls back to like a fib. So around a 38.2 fib would be here, previous support, previous resistance. It then bounces, and once it gets through 1.55, we expect around a 1.7 to 1.75 number. And when that occurs, what will be happening? Well, temporarily, it will hurt the Nasdaq. If it goes to 2, it will hurt the Nasdaq even more. If it gets past 2, well, then we're having a bit of a different discussion. But this is the expectation of a lot of people, pretty smart people, smarter than me out there. They do believe, and I tend to agree with them, that we're going to get a 1.7, going to get a 1.75 sometime in the future. That will temporarily hurt the Nasdaq, but I don't believe there's a correlation like other people do with US 10-year going up a little bit and long-term ramifications for the Nasdaq negatively. I think it's a blip and usually a fairly decent buying opportunity. Let's go over to IWM now, the indices. We've got the Russell 2000 here, meh on this, still stuck in the range, still not acting technically. This is just trapped. And if you're looking for the next levels, something like 210 would be the next level. And that's really 215, 210. That's really all we can see. QQQ, this is actually closed below. I mean, there's no real doubting it now. QQQ looked horrible on the close. I don't blame people that shorted there because you've got the peak, the trough, the lower peak, and yeah, the lower trough. This points towards the 350 being hit on the QQQ, maybe some bouncing off this level, and then of course the all-important 340, which many people will be looking for. This is a negative close. It was negative marginally yesterday. I can see why people shorted it because it closed underneath. Again, we've gotten underneath this area, and we move over to the NDX. You'll see, look at it. It's underneath. There's no real way of looking at it other than that. That's technically underneath. It's hard to be a bear in the markets, but that's the way it is. Now we're looking for this. I mean, this is our glorious trend line that's gone on for quite some time. We've got that 14,050, 14.1 level. We have the 14.5 level, which is the same on the QQQ as you saw. And these make sense. It's also very consistent with what we're talking about in S&P. Remember, if we hit these lows, this is where bigger managers have purchased before, and they will be looking at this area. This is the kind of thing that they're paying the boffins in the room with the crayfish dinners to say, hey guys, tell me where the zone's going to be. Tell me where we're going to put some of our potential money in. They're all looking at this level. So you can bring your technical analysis in, your systems in, have a look at key zones, and then make your own decisions. I mean, that's what it's all about, isn't it? You're trying to give yourself more statistical chance of being successful. Let's have a look at Ethereum. Ethereum double bottoms here. Nice base. It's moved above. I don't blame anyone for taking a buy here. We're now getting a little ascending. Look, this generally trends a little bit with the market, but that is an ascending channel here, ascending triangle. Effectively, you close above. Where do we go? I believe we go to these highs, and Ethereum is the better chart in the Bitcoin markets right now, in the crypto markets. Really nice series of higher lows. As long as that holds up and then it closed above 3,050, then it looks like that's bullish. Bitcoin, very similar. We take a look here on the 2-hour chart. You'll notice, again, the double bottom. It's a slightly better chart from it actually made a new high, but look, Bitcoin stuck within a bigger range. So it's a range within a range, just like Ethereum, and that's the way we're looking at it. I want to take a couple of seconds for anyone that's new on the videos. Anyone that's been watching for a while would know this, and I want to just bring us back down to earth. Are we in a crash? Unlikely at this situation. Are we in a correction? Sure. Are corrections very normal? Absolutely. We had 7 months of win streak that we showed at the start. And if we have 7 months, we expect a little bit of weakness after that. It's statistically unlikely to continue going on. This is all throughout history, and there's not many of them. But the statistics are also on your side in the future, because 92.9% of the time, if we came back to these markets in 6 months' time, they are up a factor of 7.9%. So will it be a buy the dip situation? Will there be corrections further lower? Time will tell. It looks pretty likely. There's some great zones there. If you enjoyed today's, please make sure to subscribe and, of course, smash that like button. And we look forward to seeing you live 1 hour before the open for Friday. Join us there, guys. It's going to be a good one. Bye for now.